Hi there, my name is Joel Spanda. I'm going to be doing a presentation on key performance indicators. They're called KPIs in short. What are key performance indicators? They're a quantifiable measure that a business uses to numerically measure their performance against the set targets or objectives. There are three types of key performance indicators. The first one is the financial metrics. These focus on revenue and profit. For example, net profit margin and gross profit margin. I'll go deeper into this as I go with my presentation. The second one is the customer metrics. They center on per customer efficiency, customer satisfaction, and customer retention, which means how well a business treats their customers. The third one is the process performance metrics. This is usually used in the manufacturing industry. They aim to measure and monitor operational performance across the organization. By dividing the number of defective products by total products produced, business can measure the percentage of defective products. Naturally, the goal will be to get this number down as low as possible, which means we need to have a minimum number of defective products. Another process performance metric is the throughput time. Throughput time represents the total amount of time it takes to run a particular process. How do we measure the key performance indicators? We use a business analytics software and reporting tools. You can also use Excel. I'll present to you 6 types of construction KPIs. And the first one is the gross profit margin. How do we calculate the gross profit margin? Is by dividing the gross profit by revenue. So the revenue is after accounting for expenses directly associated with the construction project or production of goods for sale. For example, if you have the expenses as labor and material, which is $100,000, and the revenue of $123,000, we'll then get a gross profit margin of $0.20. This $0.20 tells us that at this point in time, for every dollar of spending, you've made an approximate amount of $0.20 or 20 cents. The second one is the net profit margin. It is a more in-depth variant that you can use to measure the profitability of a project. It captures the cost of interest, taxes, operating costs on top of the types of expenditures that gross profit margin considers. How do you calculate the net profit margin? We divide the net profit by the revenue. For example, if we have the expenses as labor, material, and equipment of $100,000, the interest cost of $20,000, then the tax cost of $30,000, operating cost of $50,000, and the revenue of $1.6 million. Then after doing your math, you find that your net profit margin is $0.31 or 31 cents. That means for every dollar which you invested in a particular project, you are making 31 cents in profit, which is not bad. And this is dependent on the type of a company. Like, for example, the net profit margin of a construction industry is totally different from that of a manufacturing industry. The third one is the labor downtime. It monitors the productivity level of employees. How efficient are your employees, basically? You want the result to be very close to zero. You want your workers to spend most of their time doing what they are supposed to be doing. How do you calculate this labor downtime? Is by dividing the total number of downtime by number of working hours. For example, we have a downtime recorded, which is 1,000 hours. We have a working period of 1 million hours. After doing our math, we find that our labor downtime is 0.1 hours. This means that for every hour worked, there was a downtime of 0.1 hours, which is equivalent to 6 minutes. Planned hours versus actual hours. So before we do a project, we plan number of hours for a certain task, but usually it's not same as the actual hours. So as a contractor having employees at job sites, you should compare the work hours budgeted for a particular task with the actual work hours once the task is complete. Now, if the actual hours are higher than budgeted, it means that your profit margin may have been eaten into by the cost of the labor. So you need to find reason why it happened like that. Maybe there was a equipment breakdown, so you need to investigate and correct. The fifth one is the cost variance. The cost variance of a project at a point in time is the difference between the budgeted cost of work supposed to have been performed and the actual cost of work that has already been performed at that point in time. If it's positive, the project is under budget. If it's negative, the project is over budget. So you need to avoid that, which means you didn't do your estimation correctly, or the way you charge for that project, you didn't do it correctly. If it's zero, the project is on budget and it really does happen when it's perfect. The sixth one is a percentage of employees trained in health and safety. So this indicates the commitment to providing a safe work environment for employees by the employer. This simple KPI helps contractors prevent the occurrence of workplace accidents, while it assists them in understanding the effectiveness of their health and safety programs. How do you calculate the percentage of trained employees? Is by dividing the number of trained employees over total number of employees. For example, if you have the number of employees is 40 and the untrained is 20, therefore a percentage of trained employees is 50%, which is bad. You need to have most of the employees trained on doing a particular job, or also on health and safety. This saves the company a business money, since it avoids you paying the insurance if your employees get hurt. I'll delve deeper on how to calculate the cost variance on the next presentations. And also maybe I'll delve into how to calculate the planned hours versus actual hours. For now, thank you very much for watching. And if you have any queries or questions, please contact me on my email address tiraspan@gmail.com. Please like, subscribe, and comment on my YouTube channel. Also click the link on the description to support my t-shirt sales business. Bill it.